Hi guys, it's Wendy from Ask The Landlady, and I'm here with all the tips and tricks to help you make a profit in real estate rentals. Check out my books on Amazon, Wendy Myers. Got all these great real estate books to help you out with being a real estate investor or a mom and pop landlord, and also some stuff about timeshare, just anything you want to hear. So, anyway, today I want to talk about something a little more timely. I keep seeing all these headlines everywhere. The housing market is cooling down. It's finally a buyer's market. And every time I see that, I'm like, really? Because when I talk to actual buyers, I don't feel like anybody's out there getting any deals. They still feel like they're getting crushed. So today we're going to find out, we're going to talk about it and say, is the market actually cooling? Or is it one of those things that sounds good in a headline, out there on social media, all this clickbait, but means nothing for you and your wallet? So stay with me because the answer is complicated. And if you're in the real estate game, it matters. So just a note here, I am Wendy from Ask the Landlady, and if you're new to my YouTube channel, welcome. This is the show where we cut through all the real estate jargon and talk about things in plain language. No jargon, no flush. You don't have to have an MBA or a college degree to understand how to be a landlord or a landlady. So in today's episode, I've been wanting to do a while because there is so much confusion right now in this market. Everybody's confused. Nobody knows what's going on. So on the one hand, you got economists saying the market is normalizing. Great. That sounds great. And on the other hand, you got buyers who are still losing bidding wars and can't find anything they can afford and watching prices stay stubbornly high. It's like, shouldn't these prices be coming down? And saying there's basically no deals out there. So who's right? Economists, buyers, both of them, and neither of them. I told you this was complicated. Let me explain. So let's start with the data because words like cooling are slippery, don't really have meaning to us. Here's what actually happened in the housing market last year in 2025. I'm doing this video right now in 2026 I think it's going to drop in May. So doing it in April, but I do things a little early because I'm a landlady. I like to be organized. Anyway, here's what happened last year, 2025. With inventory, meaning the number of houses for sale, that rose significantly. We're talking about a 16% jump in active listings, which is real. That's meaningful. In fact, by November, total active listings was 1.3 million units. So that sounds like a lot until you realize that's actually well below what we were pre-pandemic before 2020. So even though we had a huge jump, it wasn't enough of a jump to get us to where we were before all the craziness happened back in 2020. So that's what we're feeling right now. And as far as price growth, because we're always tracking inventory, we're tracking prices. It basically flatlined. Prices, the national median list price for a house, about 400 to 420,000, stabilized. Barely a blip, 0.02% or something. So very, very stable there. And in some places with square footage actually dropped slightly. So we're looking at a flatlining of prices. Other factors, homes are sitting on the market longer. Days, have crept out throughout the years because you can't back, what we saw the last couple of years is that we could just throw a house out there high and get a bazillion offers, right? Because inventory was so low. And if you had to go somewhere for a job or you had to get into a house, you were paying a premium price for it. But that's not the case now. I know with my kids who live in Pittsburgh both got houses during those crazy years, and it was like, we had to hurry up and jump on a house, and the prices were like, you're trying to get in there before they were going above list price. So those were crazy. So yeah, by all those metrics, when we're talking about the prices stabilizing and inventory getting a little higher, yeah, the market cold, that's real. But here's the catch: a cold economy, it doesn't mean affordable. So that's the trap I'm talking about. Just because things have settled doesn't mean that you can afford what's out there right now. So let's talk about what it actually costs to buy a house right now. Not in theory, actual dollars, leaving your bank every month. And as of this week, like I said, I'm filming this in April 2026, the 30-year fixed mortgage rate was at 6.3%. That's down from where we were a year ago. So yay, good news, which was closer to like 6.8, 6.9. So yeah, rates have improved, but they're still more than double what they were in 2021. So here's the math. If you're buying a $400,000 house, which is slightly below that national median with 10% down, you're looking at a loan of $360,000. At 6.3%, your principal and interest payment alone is $2,230 a month. Add the property taxes, the insurance, maybe HOA fees. You're looking at anywhere from $2,600 to $2,800 per month. Now in 2021, if you had one of those lovely 3% mortgages, that same loan was about $1,500 a month. That's a huge difference, right? That's $700 every single month, forever, 30 years anyway, right? It's a lot of money that's still added to this equation. So when someone says that market is cooling, it's getting better for buyers, yes, technically, but the affordability math is still brutal. Prices haven't dropped enough to offset that rate shock, not even close. So, and I know everybody keeps saying we're talking about that, it's going to happen sometime, but this is going to be a long, low process to get to rates, and certainly those 3% great rates that we had before. So, I want to be really honest here. A lot of buyers are holding their breath and waiting for that magical moment when rates drop and prices drop and we have a big inventory. And I have to tell you that moment's not coming. We used to have those kind of moments, and they're hard to predict, right? And usually by the time you see it, oh, you blipped, it's gone. But right now in this crazy post-pandemic time, you got to pick which category, which factor means the most to you, right? Is it inventory? Is it price? Is it rates? And then you go look for that deal. So it's a good time to talk about my spreadsheet. If you want to shoot over to askthelandlady.com, I have a does the deal work spreadsheet. And what's great about that spreadsheet is it can help you pick out which factor means the most to you. And you can plug in different numbers. What if I pay this price? What if I pay that price? What if I get a loan at this interest rate? What if the interest rate shoots up? What will that happen? And you can plug all those things to my module. Super cheap, like $10. Sure, you can have AI do this, but I've already done all the work for you and picked out all the factors that you need to put in there, because you don't want to short yourself on expenses and all those types of things if you're a real estate investor. And it just lets you play with things and play with the module. So $10, just run over there and get it. What are you doing? AskTheLandlady.com. Okay, so let's get back to our issues here. So I talked about inventory, price, and rates. So let's kind of step back and look at some of these problems in more detail. So if we look at the inventory issue and say, why isn't there more inventory? Like, okay, it went up, great, but it hasn't gone up enough. I mean, what are people doing? And why aren't they selling? And that's what's really interesting about this whole thing, because it's so counterintuitive to the process. And what it's basically going back to are the golden handcuffs, right? Or that lock-in effect people are calling. Because millions of homeowners bought and refinanced homes between 2020 and 2022 when we had those historic rate lows. 2.5%, 3%, 3.5%. I mean, if you had a house, you ran out and you got a new mortgage, you refinance then because, yeah, you're going to lock in that rate. And these people are not selling, because why would you sell your house that you have a 3% rate on to go out and get a 6.9%, 6.3%, double the rate? You're not going to do that unless you absolutely had to do it. So you're going to sit on those homes, and people are sitting on those homes a lot longer. People who would downsize, like my brother has this house. He's like, I'd love to downsize. I'd love to do something different. Maybe move south, whatever. You're not going to do that with that 2.5% interest rate. It's a no-brainer. You got to stick with it. Because if you went out and bought something else, unless you can pay cash, you're looking at rates that are significantly higher and you're going to take that hit in your wallet. So what does that mean for you as a buyer, as a potential real estate investor? It means you have, slightly more negotiating room than you had 2 years ago, but you're not going to find fire sale prices. So the sellers who don't have to sell simply aren't selling. So that means you're going to have to look at some different things out there. So here's something that gets lost in all the national headlines out there, and that is that real estate is local. It always has been. So when people talk about real estate all across the country, I always laugh because I'm in Ohio. So what happens for me here is not what happening over in New York or in California, right? And vice versa. So you got to look at your hometown. Some markets, particularly, I'm looking at you, Florida, Texas, other boom towns during the pandemic, they've shifted pretty hard towards buyers. Some things have happened. Condos in South Florida, nearly 9 months of supply. And you know why that is? Insurance rates skyrocketed. People couldn't afford them. If they needed the insurance for your mortgage, it was like a catch-22 that you couldn't pay, you couldn't afford your insurance. So they had to get out. So that's a buyer's market by any definition when you got 9 months of supply sitting there. So some prices are way down from their peaks, and sellers are making concessions and they have to get out. So that's creating some opportunity if that's a market that you're interested in. Other markets like the Midwest, they remain tight. Now, there's some cities like Columbus, Pittsburgh, Indianapolis, where demand is still outpacing supply. Prices are holding because here's what happened too, is all these costs went up everywhere. People who were in other big cities and companies that were in big cities like, heck, I'm going to the Midwest where things are a lot cheaper. So prices still are getting multiple offers, and there's still demand that's super high. So there is a real need there to maybe get into the real estate investment game. So I guess what you're still at, I know this is confusing. So is it a buyer's market or a seller's market? And again, I want to say, what zip code are you looking at, right? That's going to make the biggest difference in the world. You can't say, none of these pundits out there can say, oh yes, it's a buyer's market, or no, it's now a seller's market. It depends on your zip code. It probably always has been, but particularly now when we've had so many strange factors coming together economically. So drop something down in the comments. I'd love to hear where you're trying to buy, what your zip code is, and we can have a little discussion about whether or not that's a buyer's or seller's market. I'd love to know. So do that. Okay, so let's regroup here. Is this a trap? Is this a buyer's market? It's both. And it depends where you are and what your expectations are real. That cooling is real. I won't deny that. There's more inventory, some slower price growth, homes sitting longer, all genuine improvements from last year, and for sure. But so buyers have some more options right now. So that's good. But the trap is believing that cooling means affordable. It means deal making, because it's not. Monthly payments are still high. The lock-in effect is real. Inventory is still structurally low. Prices still haven't corrected. They flatlined. So here's what it boils down to when you say, ask the landlady, let me ask you, what's your advice? And I would say, don't step back. Don't try to time the market. I know everybody wants to buy at the bottom, but the bottom is only visible in hindsight. Like later on, oh, that was the bottom. Dang, wish I'd have known that 18 months ago. It's so hard to predict. And really, as a real estate investor, it's kind of irrelevant. If you find the right property in the right location at a payment that you can afford, where you're making a profit in real estate rentals, it's a done deal. It's a deal. Full stop. So it's always a buyer's market if you can get the parameters lined up right? Now, Fannie Mae has come out and said, everybody's trying to predict that Fed rate is by the end of the year, and they're predicting 5.9 by the second quarter here of 2026. And if that happens and you're already in the market, simple, you just refinance. If you bought high at 7 and 8, yeah, refinance, great. But if you wait and the rates drop to that 5.9, and suddenly 3 million more buyers can enter the market and get that same property that you were looking at, congratulations, you just waited for the price to go up, right? So don't, buy when the math works. Don't try to time the market. Not when the headlines are saying, oh, it's cooling off, run out there and buy. Buy based on your market, your situation, your deal, okay? Get my Does the Deal spreadsheet, seriously. Totally going to help you out. So if this video helped you understand where we're at in this crazy times of real estate in 2026, are we cooling off? Yes. Are we affordable? No. That's my take home. Then definitely hit a like, hit a subscribe. It genuinely helps me reach more people out there and have these great discussions about real estate. And seriously, drop your zip code down there in the comments. I'd love to have a discussion about whether or not you're in a buyer's market, because we can figure that out. That's what I'm here for. Ask the landlady. So thanks a lot, and I will see you again next week to talk more things real estate. Have a great day.